Well, good evening, all. Ira Epstein, and here we are, and it's Friday night. I'm not even caring about the time because the markets aren't going to reopen tonight. And it's January 5th, 2024, jobs report day, and we're going to review it. This is your weekend edition of your financial markets. We're going to look at weekly charts primarily and try to get an idea. Now, the big event, obviously, today was the jobs report. And before I get into it, I have to thank everybody. We have had one of the most successful kickoff sales of a new year, probably in the history of me putting out research. My brokers, other people are writing clients, they're all coming back from vacation. I have one of my brokers, I think St. Lucia. Other people that are away, I'm getting calls from letters, hey, Ira, let me get back in and do it. Here's what I'll do. I said here January 5th. I never do this. I can't even get my IT people to change the dates. I made up my mind on this about 30 minutes ago. And I said, let's go to Sunday. That I can easily do. So the sale is extended to this Sunday. It's 40% off any yearly subscription purchase to my research for new subscribers and monthly upgrades. It is not for somebody that's got their morning subscriber yearly video and they want to move to the spider from that. I won't honor that. But if you have a spider and you wanted to go to full research, I'll do that. If you have a spider and you also wanted to add as an existing subscriber, the financial markets, the futures ones, I'll be happy to do that for you. But I'm not going to move you sideways and give 40% off, okay? What is this going to cost? Because I don't talk about the price. My morning subscriber spider video will run you about $8 a month for a year, $96. You're going to get 22 videos a month. You're going to get invites to my conference, my webinar. By the way, a week from Tuesday, mark it down, not this coming Tuesday, a week. That's when I'm scheduling my next live webinar, my special reports as they come out, and anything else I decide that my subscribers should have. There's one other cool thing that I do. You can write me direct and say, Ira, I'm looking at this stock or spider or the futures market. What do you think? And I will bring up my chart. I will bring up daily and weekly typically. I'll make a 30 to 2 minute video, 30-second to 2-minute video for you, talking right to you, showing you what I see, mail it to you, and we're done. Pretty good. I don't do it every day. So I get people that used to say, well, do this one for me, do that one. I won't do that. Don't abuse me. I won't abuse you, all right? But I'll be there to answer your questions, and I generally do so in a fast way. It's easier that way for me. And if I'm busy, it'll be later in the day. I generally make time for my subscribers, and I have a lot of them. So that's the good news, all right? So again, IraEpstein.com, go to the word research. You can move your cursor up here. It'll take you right there. And you won't hear me talking about this Monday morning. It's over. I'm not extending it. I've never actually extended this way, so it's interesting for me to even do that. Okay, so let me stop that, because what this will do is when I stop it, now I can come over here and everything works. So let me give you my take on the jobs. The market was looking anywhere from 150 to 175,000 new jobs. They got 216,000 new jobs. Yeah, there were some revisions from the prior months. You still got 216,000 new jobs. You took the unemployment rate to 3.7%. The participation rate fell 0.3. That's not very much. And wages, both month over month and year over year, went up between 0.1 and 0.2. So you have wage growth still there, slowing, no question, but growth, not negative. You have, for all purposes, full employment in America. It's not even creeping higher on you. It's a crazy month that we'll get now, because you get revisions come January. You understand December is always a little bit nutty. We're going to get people that were temporary workers off, and you'll see things like that. And that's what if you will, the pundits, the people that don't believe these numbers, they'll always say, yeah, it's skewed with this and it's skewed with that. Here's what the Fed's going to look at. The data is not worthy of a rate cut in March. And I realize at the end of the day, 60%, 62.1%, and I've got it in tonight's market letter that I've already written out. I'll put it out though on Sunday. 62.1% probability. It slipped down near 50 after the report came out because it was volatile action today. But at the end of everything, why would the Fed make its cut preemptive in March? I mean, there's got to be more data that comes out here and scares the Fed. Is this it? Not in your wildest dream. Let me say it again. Wildest dream. This is not the set of numbers that's going to scare the Fed and say they've got to move in March. Not even close. So there's got to be something else that happens. How does the market want to digest it? Well, I think over the weekend everybody will think it through and we'll see what they come up and say. When I take a look at the S&P 500 index for the week, it is down 1.77%, and the main three indexes finally lost 9 weeks of gains. It ended. No surprise. Again, you had done this. You had pulled a rubber band. Remember, I was here pulling and said, you're pulling and you let go. 9 weeks in a row, you're going to get something of a correction. All right? Was this a big correction so far? Absolutely not. In fact, it's a sign of how strong the market is and why. Even though the Fed doesn't want, in my opinion, have to cut rates in March, they got a strong economy. That's not worthy of a break here. Now, what we have to look at, all of us, is come next Friday, a week from today, we start getting all the big numbers out of the banks and all the big companies, and you know what they're going to do. I promise you they're all going to act scared. They're not going to act like it's robust. You watch. You will see. It starts off with the bank conferences. I think J.P. Morgan has a huge one this week, and you'll probably see it on CNBC. It'll be all over there. You want to watch. You want to see what people have to say. I mean, after this big of a run in markets, it's logical that you get up to a point where the market does start stalling. You're not going to get, I think at least, you're not going to get growth again this year like you had last year. Nor am I bearish. The economy's too strong. People are working. So when I look at the chart, I see the upside bias on a monthly basis. You'd have to fall back to 42.36 to even get neutral on the chart. When we take a look at the S&P for the week, you were down 1.77%, down 85 points to 47.34. A lot of traders think the 4,600 level is going to be a support zone. When we look at the market, you can see how it ran. And do you remember when I showed you an inverted head and shoulder on all these charts? I'm not going to do it again. But we had taken some numbers, and I said, if you flip them over from the shoulder, and the shoulder was right here, and I said, you could get up towards 4,700. Go look at the older stuff. We don't take it off YouTube, so they're there. You can find them. It was just a flip of a count. I mean, that's what chartists do, and that's how you learn to do these things. A correction. You can get a 50% correction from 40, let's call it 48.50, just for the sake of discussion, the 4,100, okay? So that's 400 points off the top from 48, 4,500 or so. You could fall back there, easy. Wouldn't do any real damage to the chart. The market, at some point here, you're going to start leaking away and create a trade top. I don't know if this is the beginning of it or not. The pattern on the chart is one of a lower low and a higher high. That's not exciting. And how did I come up with that 4,500? You saw one way. Tell me where the 18-week moving average of closes is. Fits right in. That's why you do that. Now, this week I couldn't even begin to go back to work on my full charting course. My intent is next week. The sale just took up everything we had. We were on the phones, people calling, asking questions. I couldn't even think during it. I didn't expect that kind of response, so I appreciate you all in a major, major way. But you can see where the market is right here. I can make an argument that you're in for more of a correction. You'll make an argument you're going higher. I'll never argue it, but here's what I'll tell you. If you think you're going to stay over this Bollinger Band, and I know traders always do. Remember, they're going to break the bank in Vegas. They're going to take that and keep pushing the bet till they own that casino. In the movies, of course, it happens. But in real life, they keep building new casinos because most people that go there, the odds are stacked against them. They know it, but it's food, it's drink, it's entertainment, it's dressing nice, it's having a ball. That's what Vegas is about. This is about your money. And there's a difference. And on your money, when you're sitting here over a Bollinger Band and you want to buy it, you're in a sucker's game. Only 5% of the time does the market stay over that band. That's not to say that it won't pull back inside of it, and if you want to buy, you might have a better opportunity. It's not to say that the first time you hit the band, if you decide to buy it here, you might be buying it actually a little bit higher. Okay, but more times than not, you're going to run into and get these corrections, and you're going to get yourself into trouble just buying over that band. Way more times than not. That's the whole idea of the algorithm. The algorithm allows the market, number one, to move up in price and still give you areas to look at. The key is to tie momentum to it. And in this particular case, you have an embedded reading. Until the red line closes underneath 79, what am I? Bullish. What will I be looking at? Potential purchases, not sales, in the market, and we'll cover that in my subscriber videos, not here. That's why I say buy here, sell there. When we look at the Dow, embedded reading, up to the band and now moving to the right-hand side, outside day down. Do you know how to work with outside days? Are they a continuation pattern or a pattern of a pause in the market? Because the market had been going up and now you get an outside day down, it is a pause pattern at a minimum. You'd have to take out the high of this week, not the day, this week, because it's a weekly chart, to say, the market's not ready to go down at all. Because you do have a piece that says you're not going to get a big break. When you have embedded stochastics, unless they turn down with the reading under 79, the market is saying on breaks, the pros are going to buy this market. That's still what I say. And why? I don't need interest rates to fall. It's unimportant. The economy's strong. That's better than interest rates falling. Interest rates will fall when the economy falters. I don't think people understand the basics. In the Nasdaq, you've got your embedded reading. Now, if the red line slips under 79, be careful. This is the market that's very rich in price. You know that. These tech stocks, the Magnificent Seven, they're the ones that led the parade, and Apple's getting living, H, ends with an L, beat out of it, right? You see that, all right? But it's also coming down to some key areas. I'll show you that in a minute here. When we look at the Russell, same thing, but the Russell's not the one to buy. You've heard me say that for a year, and it's still not the one to buy. It's the laggard. It can't even get the moving averages to line up bullish, where the red, which is the 18-week, gets over the 100-week, the green, and they're both over the 200-week. You don't even have that. You have your support zones if you were to drop hard where those markets can go, and why not? You've had 9 weeks of rallies. You can have a correction here. Am I talking bearish in any manner to you? I hope you say no, because that's not what I'm saying. I am not saying go out and sell these markets. I am saying I am still, while the stochastics stay embedded, still looking on the bull side of the market. In the 5-year note, do you think I'm even remotely surprised that if you get to a Bollinger Band and I tell you, no, I would not have you buying that market against it and you're overbought, that I think the pros are out? O-U-T. I don't think they're remotely on the long side of this market right now. 10-year note, same identical thing. You're up to the band. No, I don't see why you'd want to be pushing the long side, which means looking for lower rates right now. I'm not seeing that. In the dollar, the big question is, do you lose the embedded reading? Well, you got a number at 20. Did it ever embed on the weekly chart? Look at this. No. This is just a market that's been oversold. The daily charts were bearish with the embedded reading, not the weekly. So you're getting a bounce in the market from what? The lower Bollinger Band. Where do you see the resistance on the chart? Come on. What about the 18-day average and the 100? Now, what's going to happen this week? I'll just show you something as we walk back. Let's go back 2 weeks. 104.61, 104.44, 17-point drop, and 104.35, 33. So it's narrowing in a little. Let's assume it drops 10 more points. That's going to put it right in the neighborhood of just above the 100-day average, because the 100 won't do those type of averages. It's still going to be above it if it's just when the market reopens, and then we have to see what prices want to do, okay? So this is going to be a strong resistance area. If that 18 gets under the 100, you get another wave, I think, in futures prices to the downside. In the euro, if there's anything I teach, this is it. You get up for the first challenge of a 200-day average. It did it here, it did it here. That's what it's supposed to do. It's almost, on a weekly chart, it's a 4-year moving average. When prices come up to it, it should throw the market back on the first test. It's going to take a while to get the strength to stay over it. And you're up at a Bollinger Band. Only 5% do you stay over it, and you're overbought. That doesn't mean you couldn't get this rally. You did. But to follow it above those numbers? Nah. At least not from my perspective. Canadian dollar, same thing. You're up to the 100-week average. You're up to the Bollinger Band, and you're overbought. You buy it. I wouldn't want to have that. Now, in the yen, as I told you, the market's doing the Japanese government, the central banks, not their government, the central banks work for it. It has carried this market up, but probably a bit too high. Do I think that the central bank probably before the summer will want to get away from this control of their curve yields and all? I do. But a lot has to be done between now and March in them first getting their handle on what are the wage demands. Unlike the United States, the big wage unions go in the first quarter of the year and they renegotiate salaries and the like. I think that that's what the bank's looking for. Everything I'm reading points to that. They want to see if that'll be above the real inflation rate. What does it do? Will that act as its own catalyst to put more money into the economy? And with that, drive the inflation so that they can start saying, okay, we can get away from a negative interest rate. It sounds complicated, and it is. But you have to understand, it's been a decade plus that Japan has been fighting this. A decade plus. They're in no hurry to do it too soon. So be a bit patient. Bitcoin. Today's a big event. Late in the day, the SEC said it's going to, this coming week, make its decision. It will have its vote. I couldn't begin to tell you how the vote's going to come out, but I can tell you I've been telling my clients, and you know that, I have them on what we call a concept trade. You know, I do things not different than others. You will hear we've gone from a buy to a neutral to a whatever in the stock market. Well, a concept trade is for those traders that understand you can't do it off the chart. You got to do it on the concept. And since 38,000, I have told traders that as a conceptual long to buy the market, when it got to the 42,500 to 45 zone, I said to take off half the trade. It worked out. And I said, if it's going to pop, you got a $50,000 market if they approve this. I have no way to know if they will. Could it hit 50? I don't know that either. I'm giving you a guess. An educated guess, all right? We will see. Even if they don't approve it this round, the SEC, you know that all of the different cryptos will sue the SEC, go back to court to get something done. The problem with all this is, and the SEC is correct, it's cowboy land. If they can't control the spot market, there's danger. Every time you buy stocks that are listed on an exchange, they have control. Remember the pink sheets that they didn't have control? How many of those you hear of today? In the futures, I started in the 60s. They took total control of this game. I remember in order to register, I went to the desk when you'd walk into the floor of the exchange on Franklin Street, the old Chicago Mercantile. And I said, I'd like to be a broker. I was a runner. And they said, okay. The guy brought up a yellow legal pad of paper. I'll never forget it. And I printed my name, and I wrote it down. He said, congratulations. I said, for what? He said, you're now a broker. And I got a letter from, I think it was the Commodity Exchange Authority. This is it. I think I eventually had to do a little bit more with a fingerprint or something. I don't remember. It's 50 years ago. It was that simple. That certainly didn't test me. Well, that's what the Wild West is in cryptos. You know, you listen to these guys come out and make all kinds of crazy statements. That's what the SEC's against, and I applaud them for that. I don't want to see people hurt. We'll see what happens. In the meantime, the chart action is bullish, and that's what I am. You have an embedded reading. That's why I'm bullish. You've got the event that could happen, and I would be looking very hard at this week's low, which should not be taken out in the next 2 weeks if the market's going to take off. How did I come up with the $50,000 number? I didn't just make it up. I looked at where the Bollinger Bands might be, and I took it out a few weeks, and I just said maybe it'll get up to that level. Okay. Brent versus WTI. As long as it stays over this number, the Brent is still stronger than the WTI. On a weekly chart, you're oversold, not embedded, in a downtrend. And where are you finding support? Are you looking at this 200-week average? Pay attention to them. Can't wait to get my new course done. It's going to help you if you take that. But you learn how to look at that. So between there and the lower band, it's going to be hard to really press down that much there. And the same identical thing happened in WTI crude. I've had people saying, Ira, you're bearish. Why can't you look at it? You're hearing people are saying, there's not the demand for the crude. Maybe it'll go down more. I wouldn't tell my clients to sell the first move to a 200-week average. You do it. In the heating oil market, well, you're not quite into that support at 245.65, and you still have the embedded reading. This is still a bear market. It is not in any manner yet screaming at me, hey, come out of shorts. Now, if the red line pops over 21, yeah, then I get friendly to the market. Then I think there's something there. So you put it together, you got a bunch of things to look at. Remember, New Year's sale, 40 off. You're not going to hear me talk about it again. It ends Sunday, Chicago. That is Central Time at midnight, right on the button. Move your cursor up here. You can go to IraEpstein.com research. You have a great weekend. I'll catch up with you on Monday. I need a break. Take care.